Jeff Bezos, the world's richest man, paid $0 in federal income tax in 2007. Then he did it again in 2011. Elon Musk, the second richest person in the world, paid $0 in 2018. George Soros, zero taxes for 3 years straight. And here's what really gets people angry. It is all completely legal. In fact, we are going to reveal the exact 4 strategies the IRS allows millionaires and billionaires to use to pay zero federal income taxes. These are not loopholes hidden in fine print. These are actual internal revenue code sections that the IRS itself published. And the crazy part? Average people like teachers, business owners, and real estate investors are already using these exact strategies to build massive wealth without paying taxes on it. I know this sounds too good to be true, but stick with me. By the end of this video, you will understand exactly how this works and whether it could apply to your situation. Look, I know tax season feels overwhelming. You are probably thinking, here we go again, more complicated rules, more forms, more confusion. But here is what makes this video different. These are not theoretical concepts. The IRS literally published these strategies in the tax code, and you do not need to be a billionaire to use them. Whether you own rental properties, have a growing stock portfolio, or run a small business, these same strategies work on a smaller scale. The key difference between someone paying zero taxes and someone paying 30% is not income, it is knowledge. It is understanding that income is taxed one way, but wealth creation is taxed a completely different way. That is the game changer we are talking about today. Strategy number 1, the buy, borrow, die approach. This is the foundation everything else sits on. Here is how it works. Step 1, you buy assets that appreciate. We are talking about real estate, stocks, investment properties, anything that goes up in value over time. Step 2, and this is critical, you do not sell these assets. Instead, you borrow against them. Think about it this way. Say you own a stock portfolio worth $1 million. It has appreciated 30% since you bought it. Under normal circumstances, if you sold that portfolio, you would owe capital gains tax on those $300,000 in profits. At a 20% capital gains rate, that is $60,000 in taxes. But with the buy, borrow, die strategy, you never sell. Instead, you take out a loan against that $1 million portfolio. The loan is not taxable income, you get access to cash, your portfolio keeps appreciating tax-free, and you paid $0 in capital gains taxes. Step 3 happens at the end. When you die, your heirs inherit these assets with something called a step-up in basis. Let me explain why that matters. Your heirs receive the asset valued at the current market price on the day you die, not what you paid for it. So all of that appreciation, all 30%, all $300,000 in gains, totally tax-free. Your heirs sold it the next day for the same price, they would owe zero taxes. Let me give you a real-world example. Meet Jennifer. She is a teacher who invested $50,000 into dividend-paying stocks 20 years ago. Today, that portfolio is worth $450,000. That is $400,000 in pure gains. Under normal tax rules, if she sold, she would owe capital gains tax on those $400,000 at the 20% rate. That is $80,000 in taxes. But Jennifer uses buy, borrow, die. She borrows $200,000 against her portfolio at a 4% interest rate. She pays $8,000 per year in interest. But guess what? That interest is tax deductible against her investment income. She accessed $200,000 in cash. She paid nearly zero in capital gains taxes, and her portfolio keeps growing. When Jennifer passes away, her heirs inherit that portfolio worth, let us say, $500,000 at that point. They get a step-up in basis to $500,000. If they sell it the next day, they owe zero in capital gains taxes. But here is the catch everyone misses. The interest you pay on borrowed money, it gets deducted from your income. The appreciation stays tax-free. That is the whole game. And this is not theory. ProPublica obtained IRS data showing this is exactly how billionaires like Jeff Bezos operate. They do not take high salaries. They own appreciating assets. They borrow against them for cash. They pay barely any income tax. And now you know how. Strategy number 2, the step-up in basis rule. This is the nuclear weapon of wealth transfer. Here is the question that changes everything. When you inherit an asset, what is the starting point for calculating taxes? The answer is not the price the deceased person paid. It is the current market value on the day they died. The IRS calls this Section 1014. It says inherited assets get a new basis equal to fair market value at death. Let me show you why this matters in dollars. Picture this. Your grandmother purchased a home in 1985 for $70,000. Today, in 2025, that home is worth $1 million. She never sold it. She lived in it. She paid no capital gains tax because she never triggered the sale event. When she passes away, you inherit the home. The IRS says your new basis is $1 million. Your starting point resets to today's market value. You sell the home next week for $1 million. What is your capital gain? Zero. You owe zero capital gains taxes on $930,000 in appreciation. Now, if the law had not changed and you inherited that home with your grandmother's original cost basis of $70,000, your capital gain would be $930,000. At 20% capital gains tax, that is $186,000 in taxes owed. Instead, you paid zero. But here is the critical thing. Congress is watching this. Bills have been introduced to eliminate the step-up in basis. For now, it is still legal. But for how long? This is why timing matters. If you have significant wealth and appreciating assets, understanding this rule today could save your heirs hundreds of thousands of dollars tomorrow. Strategy number 3. Real estate depreciation deductions. This is how real estate investors build wealth while paying nearly zero taxes. Here is the part that seems like magic. You can own a property that is increasing in value while simultaneously claiming it is decreasing in value on your tax return. And it is totally legal. How does this work? The IRS allows real estate investors to depreciate the building portion of their property over time. Residential real estate, depreciate it over 27.5 years. Commercial real estate, 39 years. Here is the key. You claim depreciation as a deduction on your tax return, which reduces your taxable income, but the actual property value might be appreciating. You get both. Lower taxes today, growing asset value tomorrow. Let me show you a real example. Marcus owns a rental property he purchased for $500,000. $400,000 is the building. $100,000 is the land. He cannot depreciate the land, but he can depreciate the building. $400,000 divided by 27.5 years equals $14,545 per year in depreciation deductions. The property generates $20,000 in annual rental income. Subtract the depreciation deduction, his taxable income is only $5,455. He keeps the $20,000 in rental income, but only pays taxes on $5,455. That is $550 in taxes instead of potentially $4,000. He saved $3,700 in federal taxes, all while his property value increases. Now here is what separates millionaires from everyone else. Donald Trump reported more than $1 billion in rental losses over multiple years, losses from depreciation and property expenses. These losses offset his other income. He paid minimal federal income tax despite being a billionaire. Can average people use this strategy? Yes, if you have more than $150,000 in taxable income, there are limits. But real estate professionals can use unlimited depreciation deductions. Real estate professionals are people who spend more than 500 hours per year working in real estate businesses. That could be a property manager, a contractor, a real estate agent, or an investor with multiple properties. And the depreciation you took every year? There is a catch when you sell. You pay something called recapture tax on the accumulated depreciation. But here is the secret. Most millionaires never sell. They use a 1031 exchange instead. Strategy number 4, the 1031 exchange. This is how real estate investors literally never pay capital gains tax. Here's the situation. You own an apartment building worth $1 million. You bought it for $300,000 20 years ago, $700,000 in gains. At 20% capital gains tax, that is $140,000 in taxes. But what if you did not have to pay that tax? The IRS allows something called a 1031 exchange, Section 1031 of the tax code. Here is the rule. You can sell one investment property and purchase another similar investment property without triggering capital gains tax. You exchange the properties instead of selling. What counts as similar? Liberals rules here. An apartment building can exchange for an office building. Raw land can exchange for a shopping center. A commercial property can exchange for a parking garage. It's pretty, as long as both are investment properties and located in the United States, you can exchange them. No capital gains tax on the sale, zero. But here is the beautiful part. You can chain these exchanges together. Buy property A, 20 years later, exchange it for property B. 20 years later, exchange property B for property C. Keep building your real estate empire, compounding wealth, and never paying capital gains tax. You could literally continue this until you die and never trigger 1 penny in capital gains taxes. That is exactly what wealthy real estate investors do. Is there a limit to how many times you can do this? No, there is no limit. Billionaires use 1031 exchanges repeatedly to defer taxes indefinitely. But do you eventually have to pay the tax? Yes, unless you use another strategy. Buy, borrow, die. Remember that? You never sell. Instead, you borrow against the property. Your heirs inherit it with a step-up in basis. The accumulated gains are erased. These 4 strategies stack together. Depreciation reduces your current taxes. 1031 exchanges defer capital gains indefinitely. Buy, borrow, die eliminates taxes for your heirs. That is the complete wealth-building tax system. Let me recap the 5 biggest reasons millionaires pay 0 taxes. Number 1, they own appreciating assets instead of earning high salaries. Assets appreciate tax-free until you sell them. Number 2, they borrow against their assets instead of selling them. Loans are not taxable income. Number 3, they claim depreciation deductions on real estate, which reduces their taxable income while the property appreciates. Number 4, they use 1031 exchanges to defer capital gains indefinitely, swapping properties without triggering taxes. Number 5, their heirs inherit their assets with a step-up in basis. All accumulated gains are erased tax-free. These are not theoretical, these are actual IRS rules published in the tax code. Jeff Bezos used these, Elon Musk used these, George Soros used these, and depending on your situation, you could use modified versions of these strategies too. Now here is exactly what you need to do right now. First, if this video is going to save you money, smash that subscribe button and turn on notifications. I release tax-saving strategies every single week. You do not want to miss them. Second, this is important. Share this video with one person who is building wealth. Maybe they own rental properties. Maybe they have a growing stock portfolio. Maybe they own a business. This video could literally save them tens of thousands of dollars in taxes over the next decade. That is worth a share. Third, comment below which strategy will save you the most money. Are you considering buying rental properties to use depreciation deductions? Do you already have a stock portfolio and want to use the buy, borrow, die strategy? Or are you planning to use 1031 exchanges in your real estate business? I read every single comment and I love hearing your financial wins. Look, here is the truth that nobody wants to say out loud. The game is not about earning more money. The game is about keeping more of the money you earn. And these 4 strategies show exactly how to do it legally, but you have to start thinking about them now. Because every year you wait is thousands of dollars you leave on the table. You worked hard to earn your money. Do not let the IRS take more than they are legally allowed to take. Thank you so much for watching. I will see you in the next video.